Russia has recently invaded Ukraine. The US and European countries have retaliated with tough sanctions. The market opened lower across the main indexes, and my portfolio stocks are nearly all down for the day. Keep in mind that this is on top of the current market slump that has been going on for a few months. The stock market, like the rest of the world, is riddled with uncertainties. Is this the start of a new Cold War? Will this be the start of a Third World War? And what impact will it have on Europe and NATO's future? There are many questions, but should this incident have an impact on our investment strategy? That's what I'm going to talk about today. And I'm going to use some advice from renowned investors like Warren Buffett and Peter Lynch to help me answer that issue. But first, if this is your first time here at the Smart Stocks Academy channel, please accept my warmest greetings. Hit the like button, subscribe, and click the notification bell next to it to be the first to know when a new video is produced. So if you're ready, let's get to the video. First, let me show you a video of Warren Buffett from 2014. It is ideal because it took place shortly after Russia seized Crimea. The surrounding attitudes are essentially identical to today's, albeit less severe.
When people start to think, well, this could be the beginning of something really bad, it could be even a World War III situation, it could be a return to the Cold War, does any of that ever go through your mind?
Well, if you tell me all of that's going to happen, I will still be buying the stock. You're going to invest your money in something over time. The one thing you could be quite sure of is if we went into some very major war, the value of money would go down. I mean, that's happened in virtually every war that I'm aware of. So the last thing you'd want to do is hold money during a war. And you might want to own a farm, you might want to own an apartment house, you might want to own securities. But I mean, during World War II, the stock market advanced, and the stock market's going to advance over time. American businesses are going to be worth more money. Now, dollars are going to be worth less, so that money won't buy you quite as much. But you're going to be a lot better off owning productive assets over the next 50 years than you will be owning pieces of paper or I'm going to throw in bitcoins.
So, how has it gone since then? The world has gone on, and the SP 500 has increased by over 143%, excluding dividends reinvested. Businesses in the United States have continued to generate more money and became more valued. This is why it is critical to concentrate on the asset's value rather than all of the world's news. This applies to practically all of the concerns you hear about in the media, not just the war. In the video below, Peter Lynch does an excellent job at explaining this.
There's always something to worry about. This is the difference. This is what happens in the stock market. Because, see, everybody's got the brain power to do well in the stock market. The question is whether you have the stomach for it. That's the key organ in the body. There's always something to worry about. So people weren't buying stocks in the 50s because they thought that another Great Depression was going to happen. In addition, people were very scared about nuclear warheads and nuclear war in the 50s. People were building fallout shelters, stocking canned goods. There's something about going to Vermont, building a fallout shelter, putting canned goods in it, that you don't buy Minnesota Mining or you don't buy Eastman Kodak. I mean, the syllogism just doesn't work out that you're buying lots of water, buying a shotgun, buying frozen food that will stay in the freezer with your own generator, and you're looking at growth stocks. Doesn't seem to work out that way, Every one of these little countries has enough warheads to blow the world up 88 times. I mean, who's built a fallout shelter there, We stopped worrying about it. I mean, there's always something to worry about. In the 50s, it was depression and nuclear war. The 50s was the best decade this century for the stock market, except for the 80s. Only slightly better. The 80s are only slightly better. People didn't expect a lot. We had it wasn't a great decade. They just didn't expect much. We made it through. And the stock market was terrific. Do you remember when oil went from 4 to 40? Remember that period? Oil went from 4 to 40, and the experts said it was going to go to 100, and all the countries of the world were going to go bankrupt. And then the big banks are going to go bankrupt, and we're going to have a Great Depression, and the stock market's going to go down, and you're going to wind up selling pencils and apples. Well, I remember when oil went from 4 to 40, and the experts said it was going to go to 100. Within 2 years, oil was at 14. The experts, now much higher paid at this point, are saying it's going to go to 4, and we're going to have a depression. And people believed it again. I remember when the money supply was growing too fast, and you said we're going to have a depression. Then it was growing too slow, we're going to have a depression. Then the Mideast was going on the world. Remember that one? The Mideast was going on the world. They weren't going to buy our bonds, and the market would crash, and we're going to have a depression. Then Japan was going on the world. Remember that one? Japan was going to have all the assets, and they weren't going to buy our bonds, and we're going to have a depression. Within 3 years, the Nikkei Dow had gone from 40,000 to 16,000. The banking system was in trouble, and people said Japan was going to collapse, and we're going to have a depression. I mean, people had, on their prayer list, at the end of the day, they had eliminated crippled children and Mother Teresa. They're praying for Japan. I mean, it's a country with a 15% savings rate. It's so bizarre. Commercial real estate, global warming. And I think as the older you get, the more nervous you get about these things. I think it's very valuable. I think while younger people are better investors, is they're not worried. They haven't heard about all these crises. And they're with children. I think if you don't have any kids, you got to rent some kids for the weekend. Get a 7-year-old and ask him if he knows about the money supply, how fast it's growing. Ask him if he knows about the shape of the yield curve is the wrong shape of the yield curve. Or that we're 48.3 months into the economic recovery and the average recovery lasts 52.3 months. Ask an 8-year-old if they know about that. 8-year-olds have a very high expectation about the next 20 years. That's what you need to do. The more you get away from 8-year-olds, the more you get away from 11-year-olds, the more you start reading these crazy things you read over the weekend. But I'll guarantee you, the market will be a lot higher in 15 years. It'll be a lot higher in 25 years. What it's going to do in the next 1 or 2 years, I don't have any idea. So I don't worry about that. I know we've had 96 years a century, and the market's fallen 53 times. We've had 53 declines of 10% or more. So 53 declines in 96 years. Once every 2 years, we have a 10% decline. Of the 53 declines, 15 have been 25% more. So 15 in 96 years, about once every 6 years, the market falls 25% more. That's what we call a bear market, you know that. And it's going to happen. I don't care when it's going to happen. I would love to know. Obviously, it would be very useful to know when it's going to happen. It doesn't make a difference to me. Corporate profits will be a lot higher 8 years from now, a lot higher 16 years from now, a lot higher 30 years from now. That's what I deal with.
When investing, your first attention should always be on the underlying firm. What are the current earnings of the company? How much will the earnings increase in the future? How confident are you? And does the current price make it appealing? That is how the game works. You will always be able to find a reason not to buy if you're focused on the macroeconomy or current events. As a result, you should consider if the Russian and Ukrainian crisis will have a big impact on the long-term earning power of the enterprises you invest in. Will Disney be able to make less money in the future? Will Microsoft be able to? Will there be an Apple? Will PepsiCo be able to compete? Or will Coca-Cola be able to compete? The focus must always be on the business. Is this occurrence having an impact on my investment strategy? No. I'm going to keep buying high-quality enterprises at reasonable prices and holding on them for the long haul. And with that, today's video comes to an end. If you haven't already, hit the like button below to show your love and support for this video. Also, subscribe to the channel by clicking the subscribe button below and turning on the notification bell next to it to be the first to know when a new video is posted. Thank you for stopping by to watch, and we hope you had a great time. We hope to see you again soon.